Hello. We are experiencing minor technical difficulties that if you're watching this, you are not experiencing. So glad you made it. And we've got an awesome crew here today, Matt and Nikil, to talk about interchange, which is maybe a fancy word for payments. I don't know if I can say that. Whenever I hear interchange, I think payments. But I'm sure that they'll educate me on how that is or isn't the whole story. But more excitingly, to kind of get into it, if you've been here before and you know me, we do a decent number of these, always very kind of niche venture/tech panels. If you're into this type of stuff, you'll like it a lot. If you're not, you'll find out very quickly that you don't that this isn't relevant. But if you do like this stuff, we have a Luma that has all these events. You can RSVP to them kind of in bulk or as you see fit, and we have a daily-ish, more like weekly-ish newsletter. And we have a syndicate. That's like a syndicate that you'd see on AngelUs. We do a bunch of early-stage investing as long as in late-stage stuff, sometimes in the fintech space. Much more importantly, as I kill time here, I'll let them give better intros, but Nikil is the head of expansion at Lithic, streamlining the creation of business payment cards. I'll let him kind of describe it more, but you've probably seen his work. You just didn't know it was them. And I'll let him explain kind of how that works. And before that, he was on the investing side at NYCA, NYCA Partners, NYCA, or Sageview. I'm forgetting if I'm pronouncing that right. And then Matt at Matrix, which just did a great rebrand and brought on a new partner who I saw that. And before that was head of product at Afterpay. So from the payment space, now on the VC side, I was just writing a little description of Matrix, who has Apple on their portfolio page, which is just so crazy and great because they've just been investing for a really long time. So I was joking about that in some of the marketing to give a context to how tenured Matrix is. But with that being said, I've killed enough time here, and we've got people kind of in the crowd ready to go, so we can get into it and get much better intros for you guys than personally than I gave. I hope. How are we doing?
Excellent.
Good. Yeah. A little. Where are you at, Matt? Where's this background? What am I looking at?
This is our San Francisco office. We are here at First and Mission.
Nice. And originally Boston. Am I thinking about that right?
Yeah, originally still Boston. Still have an office in Cambridge.
Yeah.
We have some folks in New York, and San Francisco as well. So
yeah, very cool.
All over the place.
Yeah, that makes sense. And I was joking about the rebrand. Very cool. It's matrix.com, right? Or is it matrix.vc?
Matrix.vc.
Matrix.vc.
Yeah.
And who's the new partner that just came on? Who was I thought there was it a new partner?
TJ Parker. He was is the founder of PillPack, which was acquired by Amazon and became Amazon Pharmacy and led a bunch of healthcare initiatives there.
Yeah. Cool guy. Cool car collection from my Twitter following of him. But anyways, it was awesome to see him join the fold at Matrix. But I would love to get and whatever we're not going to ignore you, Nikil. Me and Nikil were chatting before, right? So I kind of got this out of my system before. But Matt, I'd love to get a little background on you and obviously on Matrix, and then we can do the same for Nikil and start to get into it.
Yeah, absolutely. I'll start with Matrix briefly. So we're an early stage venture firm, have been, as you mentioned, in business close to 50 years. So one of the older, more tenured venture firms in the US. We are pretty consistent across the decades in how we invest. So number one, early stage only, concept to Series A. We don't do late stage investing, don't have a hedge fund, don't do growth investing. We are typically working with founders at, kind of the whiteboard stage all the way up to their first real institutional round of capital. Number two, and this kind of gets into the interchange topic a bit, is we're generalists as a firm, but individual investors are specialists. So, TJ, as we mentioned, focuses on healthcare, other folks who focus on semiconductors or B2B SaaS. All I focus on is fintech. Like, that's where my background is. That's what I know. That's what I stay up late at night, reading about when I should probably be going to bed. And that's just what's interesting and exciting to me. So that's all I do. And then lastly, we're very small team, 10 investors. Everybody's a former founder. Everybody's built, scaled, and sold companies, and is very hands-on with the companies they invest in and work with. And that kind of comes back to this, focus on what you know. Do small number of investments. When we invest in a payments company, it's not because we read some report on, McKinsey publication that payments are the future, but because we've seen some of these trends, in our own past experiences. So, that's Matrix in a nutshell. And then my background, like a lot of folks here, I mentioned, started 2 Matrix-backed companies before. One was the second one was started as a vertical software company called Bonsai, eventually added payments acceptance and card issuing. So have been on the builder side of a lot of this stuff. And that was pretty transformational to our business, being able to monetize not just SaaS, but all these other financial products. And like a Shopify or like a Toast or whatever it is, had that combination of software and financial products, which was, again, big boost to the business. Then was head of product at Afterpay, which is a buy now, pay later that was acquired by Square, and joined Matrix a little over 2 years ago.
Cool. Nikil, now 10 minutes in, now you get to talk.
Well, first of all, thank you, Adam, for having me. I'm a big fan of the Sandhill Report and also the daily-ish newsletter.
Oh, good.
Let's see, I'll do Lithic first as well, and then myself.
Cool.
So at Lithic, we build API-first payments infrastructure. We're known, of course, for our state-of-the-art card issuing and processing platform. We've helped well over 100 companies at this point on their card issuing journeys. Some of the customers that we support that the audience might recognize include Mercury, Novo, Papaya, other startups and growth stage companies like that. I've myself been at Lithic for almost 4 years now. I'm currently head of expansion. Nice.
It's my Mercury card.
Fantastic. Yeah. Awesome. So yeah, I've been at Lithic almost 4 years, currently head of expansion, worn many hats as you do at a startup, including sales, customer success, things like that. Before Lithic, I was on the investing side, as you mentioned, at Nika Partners most recently, where I was investing in early stage fintech, and then always just had the bug to roll my sleeves up and build at a startup, which is how I found my way to Lithic.
Awesome. Well, in terms of kind of run of show, we talked about this a little bit before, but I'm hoping to have you two kind of give us a little history lesson, not too far back, but like there's a 2010 to 2020 period that we had kind of talked about in the pre-show doc, where we saw a real uptick in new fintechs and some more action kind of in this area. And then when we move out of that into like the kind of more recent past, 2020 to today, and then move in and talk about the future, kind of what you're seeing. So with that, I'd love to have, and either of you, one of you can take this, but there's this, explosion from 2010 to 2020, like just a lot more fintech action, I guess to say, and that's me coming in like semi-uneducated about it. Can you describe that period and what was maybe like why 2010? Like what was the starting point? Were there any catalysts that kind of brought this on that everyone kind of agrees on, or was it a mixture of things? But yeah, I'll toss that out and let one of you all start educating us.
I can try and take a crack at it first, and then Matt can definitely correct me or add. So I'd say obviously you needed kind of both necessary and sufficient conditions for like a big change like this. There's some stuff that people often will talk about that maybe form the necessary conditions here. So like, the sponsor banking ecosystem really started to come together. And, if you're launching fintech products in the US, typically in a sponsor or partner bank that's helping you do that. They've got licenses to actually issue cards and things like that. So that ecosystem really started to come together. It used to just be folks like Bancorp, but then now if you look at it, you've got several dozen sponsor banks that are willing to work with fintechs to launch accounts, lending, payments, you name it. So that was one. You also had the rise of kind of middleware providers, if you will, basically better fintech infrastructure providers that would allow fintechs to build without having to do all the heavy lifting themselves effectively. And then there was some regulation as well that helped. So you've got the Durbin Amendment. We could get into that if we need to. So those are probably the necessary conditions. But for me personally, I think what doesn't get talked about enough are kind of the sufficient conditions there. So like really, I think what ended up happening was that there were larger technological platform shifts that were happening behind the scenes, right? You had the shift to mobile, you had the cloud basically. And so you had customer expectations shifting because of the experiences that were being delivered by folks like Amazon and Apple. And they were looking at those experiences, comparing that to what they were getting from like Chase or Bank of America or Wells 10 years ago and saying, what the heck? Like, absolutely not. We can do better. We deserve better. And so really there was the demand for better products there that fintechs, I think, came in, filled that gap, and really had just the right environmental factors, the conditions to launch for the first time and kind of, eat the incumbent's lunch, if you will.
Oh. Matt, what do you think?
I think you covered it well. My editorial comment on that, and it's part of what makes fintech so interesting to me, is like it's not a purely tech driven industry. It's not a purely financial services driven industry. It really is the confluence of all these things. And so as you mentioned, there are these shifting consumer expectations. There was people moving to their phones and being able to do a lot more on their phones. There was like the price of compute coming down, and all these startups growing as a result of it, the launch of the app stores and the ability to distribute products and acquire consumers much easier. There are these regulatory changes. You mentioned the Durbin Amendment, which again we can get into, but basically made card issuing and debit cards more a viable business model for a lot of companies, which again I'm sure we'll talk a lot about. So it really is the combination of all those things. But I think that's what makes this space very interesting. It's not just a tech change. It's not just a regulatory change. It's not just a consumer preference shift, but it's kind of the confluence of all those. And I'm sure we'll talk about post 2020 as well, but you see all those things shifting as well. A change in what's possible with the tech platforms, has an effect on the industry, as does these, regulatory changes as well.
Just stay kind of in this 2010 to 2020 period a little bit more. Can you throw out some names and some like models for the audience that you think were like kind of definitive of that run and whatever? I think everyone kind of has some names in mind, but because fintech, and that you kind of mentioned it, Matt, but like fintech is a very broad term. Like fintech, like most things have money involved if they're going to be making money in one way or the other, kind of in the tech space, and so fintech can be a very broad area. Like this is obviously titled interchange, and interchange is like this little tiny thing that most people, whatever, not tiny from market size, but tiny from like a term perspective. In a long, you mentioned even sponsor banks got thrown out there, which I don't think that average person would really understand kind of how the layering works on top of what they see. But as people that are kind of deep in the space, could you throw out some maybe both well-known and maybe less well-known like pillars of this 2010 to 2020 fintech ecosystem that you felt like defined some categories that came out of it?
Yeah, for sure. One framework that might be helpful is you have kind of you think about the application infrastructure. So infrastructure are the businesses that sell to other businesses and enable them to embed financial services or do something around financial services. So I put the banking as a service providers like a unit, for example, in that category. On the payments acceptance side of things, like a Stripe would definitely fit into that. And then above that, on the more application side, you have consumer facing and business facing. And that's relevant because particularly in financial services, they're often different. Obviously, there are very different product requirements and distribution strategies, but different regulations. Consumer lending is very different than business lending, for example. But within, let's say, the consumer side of things, you had the whole wave of neobanks like Chime or Dave. There are a lot of these, again, consumerized lending. Robinhood being kind of the classic example there. You had on the business side, you had similar versions of these on the kind of neobanking side, if you will. You had the Brexes of the world. And then there's a whole embedded category as well, which, you wouldn't say that they're pure fintechs, but like a Shopify, for example, started as a SaaS business, but makes a significant portion of their revenue today from payments acceptance and lending and things like that. So I think the interesting categories are the ones where they're starting to merge software and financial services. But those are some of the big names. And I think
kind of jump out. Yeah.
Yeah.
Nikil, any additions, or does that seem pretty? And I guess for me to regurgitate a little bit before, and you can correct me, Nikil, because there's this I said layering, but I think that's a good way to think about it, right? Where there's the infrastructure stuff that a consumer, if you're not an operator in the space or an investor who's thinking about the stack, you're not really aware of these infrastructure players that are, large and have, weren't there before and, now enable a lot of the tools that are built on top of them. And then there's that, the things that people are more commonly attuned to because they're experiencing them, where it's the consumer facing stuff, like the Robinhood obviously would be like, oh, fintech, VC backed fintech winner that like made it or whatever. And then there's the B2B. So it's kind of like the infrastructure layer. This gets cut up in a lot of different ways, and there's some, there's plenty of like complicated market maps. I don't know if Matrix does any of those, but there's complicated market maps that like, actually break it out. But I think that key term of layering and then consumer and B2B kind of as the really simple, like Foursquare version of what's going on. Nikil,
I'd say that's fair. Right? Yeah. I mean, like one of the most recognizable brands for most consumers in the US is probably like a Cash App, right? Totally. Like most consumers think they're interacting with what feels like a bank. Cash App is not a bank, however. Like underneath the hood, they're working with an infrastructure provider like a Marqeta, who's actually helping them as the card issuing platform, if you will. And typically there's going to be a bank behind the scenes, an actual bank. I think in that case, it's Sutton Bank. That's the actual license holder, the one that goes through bank examinations and everything else to make sure that the product being offered out to consumers is compliant, that they're doing all the reporting that's necessary, the KYC, the onboarding, those types of things. So yes, I think layering is a good word potentially, because there's many layers in the stack there to actually provide that type of service that any fintech provides at the application level.
Got it. Yeah. Well, so we saw like some of this infrastructure get built. It enables like a lot of this growth to happen. But you both mentioned a regulatory thing before we kind of move on from this period into the more recent past. You both mentioned what was the Dodd-Ford Act? Was it that what happened?
Yeah, this was the Durbin Amendment.
Durbin Amendment.
Yeah. So I want to say it was Senator Dick Durbin. I forget the exact year in which this amendment was passed, but effectively there was a new law that was passed that said if you are a financial institution that has over 10 billion in assets, then the interchange fee that you're able to earn on a debit card transaction is capped. I believe it was capped at something like, I want to say 20 cents and 5 basis points. Last I checked, at least. So importantly, that was for like a prepaid or debit transaction, not for a credit card transaction. Credit in the US by and large is still uncapped interchange. And so there's like a market clearing rate that ends up being affected through Visa and MasterCard. Okay, but then, so I mentioned this is banks above 10 billion assets.
Yeah.
For banks below that much, effectively it's like you can make more money, right? The big banks are capped in the amount of interchange they can earn, whereas the smaller banks could earn basically whatever Visa and MasterCard set for those prepaid and debit transactions. So call it 1.5% for ease, which is pretty close to accurate. So what ended up happening there was all these fintechs would say, I'm going to go partner up with these smaller financial institutions and issue debit cards with them, where I can take care of the growth marketing, the customer acquisition, the branding, build the front end, all of that cool stuff. And we'll make 1.5% on all that our cardholders spend. And we'll split between us and the bank, and everyone's happy. Kind of, that's the short summary, I would say. Matt, let me know if I missed any of the critical details there in your opinion.
No, I think you got the key points there. One thing I'd mention that I think is interesting of this period of like the unintended consequences of where a lot of this came from, which was the global financial crisis and all that, for folks that are old enough to remember that. I talk to a lot of founders these days who are like in middle school when that happened. But there are a lot of these like consumer behavior shifts that happened as a result of that ultimately benefited the startups that became big companies in this wave. So one was the distrust of traditional financial institutions, or the kind of dislike of them and the willingness to try something new. So if you kind of went through that and had this negative perception of Wells Fargo or Chase or whatever it is, you might be more open as a younger person to try a Chime, to open a Chime account, to open a Dave account, whatever it is. Similarly, and related to interchange in particular, there was this big aversion amongst younger folks in 2010 to probably even today to traditional credit products. And you see this show up in a lot of interesting statistics where, like, your average, you rewind to 2005, significant portion of folks in their 20s have a credit card and are carrying a balance and something like that. And then post financial crisis, credit utilization amongst younger folks drops. And so, but you need a card, you need to spend, e-commerce and all this, you need to spend in some way. And so there's this, I would say, maybe not increased demand for debit cards, but at least the acceptance on the consumer side of debit cards as a product remains strong. And as an interesting aside, that was a big factor in the rise of buy now, pay later as well, where if I may, kind of rewind to the mid 2010s when Afterpay and Affirm and Klarna were kind of getting started and growing. You're a younger person, you're checking out an e-commerce store, you don't have a credit card, you don't want to carry a balance, you're not able to carry a balance, but you want some flexibility in making that payment. And so that kind of arbitrage between the desire for some kind of a credit product, but the younger kind of generation not wanting a traditional credit card is what gave rise to the entire buy now, pay later industry as well.
Yeah, interesting. Yeah, and I think, as a close enough to that kind of period to have felt it, it's definitely very real. Like, everyone who, grew up in the can't trust banks era, right, is where we live now. And not that startups, right, there's maybe conversation to be had about the risks on the startup side as well, because there's two sides, right? Like, startups are startups, like big banks aren't, as we've learned, right, like forever. But so there's always kind of, I don't know, balancing risks of what you want to be like a very secure thing, obviously. So the title of this, though, and that you use the word, we both kind of thrown it around a little bit, but I think that for people in the audience who maybe aren't as familiar, can we break down like what interchange kind of actually is for people? I think that I was joking with Nikil that I'm a non-payments founder. My best friend is a payments founder, so I know what interchange is from him, and like how much and I've seen the bar charts of like how it gets split up. And again, as a consumer, and even lots of businesses don't think about those fees or who's getting paid, and that's kind of a semi sneaky part of the payments. Like, the elegance maybe is a better word is a more positive word to use. The elegance of payments monetization, where you just don't even feel the 3 cents that gets charged, or like the 2% or whatever. But interchange is that cut, right? Is that like, where the actual dollars are getting taken out and thrown to, the service provider in this, or, the platform provider. Can you guys break down a little bit, like, when you say interchange, what are we talking about more specifically?
Yeah, I'd say from my perspective, maybe a really simple way of thinking about it is that interchange is the compensation earned by a card issuing bank for its role in kind of maintaining the integrity of the card payment system. Maybe simplify that even more. It's just, hey, I'm a bank. I gave you a card. You go out and spend it with a merchant. I, as the bank, am the one who's actually on the hook to make sure that funds do reach that merchant, that funds are available for that merchant. And so that's risk inherently. Like, did I onboard the right cardholder? Are there going to be chargebacks? I have to maintain and do customer support for that cardholder. Like, there's credit risk involved. So for all of that risk that I'm taking, all that work that I'm doing, I'm hoping to make some money for that work. And that's kind of what the interchange is. That the card networks have set up this incentive for the banks to do that work. Got
it. Yeah, and Matt, can you break that down a little? You mentioned the card networks as well, right? Because there's in the interchange, $1 gets spent, and then there's a little interchange at the bottom that's like, whatever the percent that gets taken off the top. And then that little bit, there's the issuing bank, there's maybe the fintech on top of the issuing bank, there's the card network. Like, walk me through a little bit of like the different people that are pulling out of that percentage. And maybe there's, that changes in different situations, but can you break that down a little bit?
Yeah, it's a very complex topic, but so you mentioned the consumer typically doesn't feel this, and that's right. These fees are typically paid by the merchant. So if I go to the store around the corner and swipe my card and spend $100, from my perspective, I'm just paying $100, $100 leaves my account. The merchant will typically receive, call it $97. And that $3, that 3% is what's then broken up. And the way to think about it is there's this like series of middlemen between, the money in my bank account and the bank account of the merchant. And as Nikil mentioned, like everybody in that chain, all those middlemen that move the money and play some kind of function along that path to get the money from my bank account to their bank account takes a little toll of that 3%. So, as you mentioned, let's say I bank with, I bank with Chime, the Chime card. Chime gets a cut of that because they're responsible for issuing the card and they've paid to acquire me as a customer and they do customer support for me and things like that. Underneath the surface, it could be, Lithic that's actually helping to manage that card program. So Lithic gets a portion of that. There's a sponsor or partner bank that gets a portion of that. And then that's kind of interchange itself. Then there's a second set of fees, which are network fees, and that's actually paid to. You look at your card, regardless of who, whether it's Chime or Dave or whoever it is. There's typically a Visa or MasterCard, or in some cases Amex, logo on that card. That's the actual network that connects these sponsor banks, and that then connects all these end users of the cards and merchants that accept payments from those cards. They take a portion of those fees as well. Again, to maintain that network, to set the rules, to acquire and manage the relationships with all these sponsor banks. So again, think of it as like all the different steps that the money needs to travel from my account to the merchant's account. Each of those folks takes a portion that's proportional to like the risk that they take and the relationship that they have with the end user.
Yeah. I'm trying to think about the Visa MasterCard risk. Visa MasterCard just print money. I've been printing money for like a decade. It's crazy. But moving out of, okay, so that 2010, I think we have like nice kind of some term descriptions, like, the players we're talking about went through this big infrastructure getting built, the ability to charge more, like this kind of market opening up, right? There's a little regulation, right? And Nikil gave us a nice breakdown. And then from 2020 to today, there seems to be some other kind of trend shifts that I'm really not as aware of. I understood and, kind of the basic history of like how fintech has just gotten bigger over the course of the last, decade or so. And from the stuff that you guys talk about, but I'm not as familiar with what's been experienced in the last, 4 or 5 years. Is it, drastically different than what we just talked about? Like what did something happen? Where are things?
Yeah, from my seat, I'd say one big theme has been kind of consolidation, into consolidation, obviously in the sense of like M&A activity, and that some of these smaller fintechs have been kind of getting rolled into the larger platforms, and that there's some good reasons for that. They've got kind of installed bases of customers, and so they've got distribution figured out, and so now they're kind of reselling and cross-selling to those existing customers, which is always been one of the harder things to do for new fintechs that are coming up, is customer acquisition. And so if that's solved in a bigger platform, it's easier. So that's kind of one reason for the consolidation. Another one, really, when I say consolidation, I kind of mean that there's been kind of fewer new fintechs, I'd say, in the very recent couple of quarters. And that's because I think it's the realization that just because you can build something doesn't mean you should build it. You need to be hopefully solving a real problem or having some sort of competitive edge, some sustainable moat, or something that justifies you making the investment to go and launch this thing. So I'd say there's been fewer Me Too fintechs in the last couple of quarters, whereas in that 2010 to 2020 period, every couple of months I would see a new pitch for a new neobank that unfortunately maybe didn't have a real niche segment it was going after, or sustainable economics, or something differentiated enough about it. So I think that's been one theme. I think it's a good thing, though. I just want to make that clear. I think it basically means that there's more quality, whereas previously there was maybe a little bit too much noise in the ecosystem generally.
Yeah, interesting. Matt, is this similar to what you, because in the investor chair, I'm sure that you get a good sense of, I don't know, kind of quality, the noise factors, and just kind of the general rate of new things and kind of themes there. Does that line up with what you're experiencing?
Yeah, I think the neobank example that Nikil gave is a good representation of kind of what's happened here. There, the mid 2010s, you had a variety of these banking as a service providers pop up. It became much easier, much cheaper, much more straightforward to launch something like a neobank. And so you had this explosion of neobanks, and like it seemed like in the late 2010s, every other week there was like the third neobank for pet owners and the fifth neobank for, they're like all these, and there was, I think the arguments and the visions for them were valid in some way. Like financial services, there is like an affinity aspect to it. Like you do want to, there is a personal aspect to it. But I laugh when people talk about AI companies today and say, oh, they're a thin wrapper on top of chat GPT or whatever it is. A lot of these at the time, a lot of these neobanks were, and to the extent that they still exist today, are like thin wrappers on top of a banking as a service provider who's a thin wrapper on top of a sponsor bank. And so if that's the bulk of the value that you provide, it's difficult to have a differentiated value proposition. It's difficult to be able to then have a high enough lifetime value of your customers to spend enough on customer acquisition to like actually get the business going. And so to Nikil's point, a lot of these kind of undifferentiated companies, that are just kind of riding on top of this thin wrapper of some other infrastructure provider have kind of gone away. The ones that survived, and that's where I think a lot of the surviving and successful companies today are, have done a few things. They've verticalized or specialized. So they're not just like another neobank. They've really honed in on a segment that it actually makes sense to focus on. They've typically bundled multiple financial products. So it's not just card issuing. Maybe they've gotten into lending. Maybe they've gotten into, there are many variations, very interesting variations on this that we can talk about. Or maybe they've added non-financial products as well, which is where particularly in B2B, we've seen where you're combining whether it's payments acceptance or card issuing with some kind of a SaaS product or a subscription fee. Both Brex and Ramp, which were, started off as banking card, primarily as a bank account and or card issuing, now have paid, per seat subscriptions. That's a pretty prominent part of their offering. So I think that's very representative of the way this, the various sectors of fintech have gone over the last couple of years.
And again, for me to kind of regurgitate a little bit too, where there's this explosion, the 2010 to 2020, everyone's launching a neobank and built off of the infrastructure getting better, right? Like, which is maybe, and I guess to pause there, has the infrastructure layer, because the thing that, we joke about, the neobank for cat owners rather than, the neobank for dog owners or whatever, those are enabled by a really healthy infrastructure layer. Did we experience or see the kind of failure / consolidation just at the consumer level, or has the infrastructure layer that I don't experience as much, but you two are more familiar with, has that followed that same sort of trend? Like, were there Me Too infrastructure layer businesses or not as much?
I'm smiling because it was the perfect question. The answer, I think, is absolutely yes. There was very much this bullwhip effect, if you will, where basically there was the identification that the fintech application layer is exploding. Let's all basically sell picks and shovels, right? And so the infrastructure layer, there was just a ton of investment and potentially too many companies being built at the infrastructure layer. And then it was just too late in some cases where some of the big winners and the application layer were already built. There weren't as many new folks there building. And so now you just have all of this supply of infrastructure trying to compete against themselves. That also ended up happening. And we saw some consolidation in that space as well. Some of the banking as a service companies were acquired or kind of fizzled out. I think Rise may have been acquired by, I want to say Fifth Third. Bond, I think, was acquired by either an FIS or a Fiserv or someone like that. And so a lot of the smaller players basically kind of, ended up rolling into bigger platforms, and there was some consolidation there as well. I think there will be more to come.
As it kind of lags consumer, like it's kind of like just generally lagging the consumer trend that we already saw or have already seen play out.
I think so, yeah. And kind of to Matt's point, actually, and the ones that are continuing to do well are, even at the infrastructure layer, being more specialized, focusing on a specific type of customer segment where they have a clear right to win, or potentially are really building it further layers in the stack where it's not just like a middleware provider that's bundling different technologies together, but like truly is building something innovative at the technology layer themselves.
Matt, on the investment side, I'm sure you deal with this whole rise and fall just generally.
Yeah, I was going to say, I think this kind of cycle between like infrastructure and applications, there are a lot of like I forget the name of the book, but I think it's a professor, Carlotta Perez, has this interesting book on like technological and financial capital and different cycles between technology and the deployment of those. But you see this across industries, right? Like you think about even the SaaS in the beginning of cloud, right? There were multiple cloud providers. AWS was kind of one of many, and a lot of times they initially sold to earlier stage companies, a lot of startups, and over time, the vast majority of those startups failed. The vast majority of like hosting providers failed. A few startups got very big with this model. And then it over time became not just startups that were built on, say, AWS, but a lot of like, enterprises and, what you would consider non-software companies built on top of that. And I think that's where you're seeing this like maturation of the infrastructure layer in fintech go as well, where, the seventh, neobank for dog walkers isn't getting started or has kind of died off, but whether it's a traditional financial institution that is using these platforms in some way, or maybe it's like not a traditional fintech that is saying, hey, let's not launch a neobank, but like there's some complex money movement flows that we can enable within our platform, and it's not going to look like a neobank, it's not going to smell like a neobank, we're not going to describe it as a neobank, but like we can actually use banking as a service in a very interesting way to enable this use case on our platform. So I think that's where you see a lot of the surviving infrastructure players being successful.
And I think that's a great segue into something that we had on the kind of pre-show doc about both. There's two kind of conversations here. One is like alternatives to traditional interchange monetization or traditional payments monetization. But I think you kind of touch on it happening from both sides. Like there's the pure like, oh, we've always been a fintech company and we monetize on interchange or whatever, that are getting more moving into SaaS, right? And like kind of adding from that side. And then there's also we were just SaaS and now I'm moving into, like, I wouldn't have described myself as a fintech, but our users, they live in here already. Like if we provided this to them, which is technically a fintech service, they would benefit from it. So it sounds like there's like mixing, like a little bit of like a mixing from both sides of that and into some middle area that has, fintech kind of being everywhere, or like, it's kind of may or may not be a fintech company, but it has a fintech angle to it. What does that like look like in practice? Like, is that first of all, is that a new trend like as of this year? Is that something that started in 2020? Like, it sounds like it's building off of that sort of trend that you both talked about, but let's go a little deeper there to explain to people maybe what examples are and if you see that continuing into the future.
Do you want to take it?
I was going to say, I feel like you wrote one of the seminal works on this one that I really appreciated. So I feel like you should hit this one first.
Yeah. I mean, they're definitely combining. I would say, even though I like talk about myself as a fintech investor and all this, I do think in 5 or 10 years, describing your focus as fintech will be as kind of useless as describing your focus as like software. Like even car manufacturers have a substantial, software component to what they're doing today. Fintech, it won't be as prevalent as that, but I think it will be much more prevalent and much more diffuse than it is today. And particularly in B2B. And that's where I spend a lot of time in like vertical software and B2B software, where at the end of the day, you're, if you're selling B2B software, you're touching money in some way, or you're one step away from money. Maybe you're helping to manage expenses. Maybe you're helping businesses get paid. Even if you're, I'm just kind of making this up on the fly, but even if you're a scheduling software, like I saw Calendly the other day, they're known for booking and scheduling, but a lot of booking and scheduling, you have to pay a deposit. Maybe I want to go, book a yoga class, but I have to pay a $50 deposit. They now have payments acceptance and scheduling software. And this is just like a point solution for one thing. So I think many kind of founders and product managers don't have to squint that hard to see where their products and their businesses can be more valuable by being closer to money in some way. And like, because you have this more robust infrastructure, it's because it's much easier to accept payments, because it's much easier to do these complex flow of funds, because it's much easier, thanks to Lithic, to issue cards and things like that. The bar for doing this is lower. And again, I went through this myself in 2014, 2015 with my previous company, where I would have considered myself a SaaS founder at the time. Like, I knew the SaaS playbook model very, very well. And Stripe at the time was kind of one of the better games in town for this. But we're like, hey, let's start accepting. We have this online invoicing product. Let's allow our users to accept payments online. You can embed a cool credit card form, and their customers can type in the number. And oh, wait, it's really awesome. We can actually get a portion of those payments as revenue. And so that incentivizes us to build out that product and make payments even easier, and think about what happens when the money flows to our users. Can we actually give them a bank account that accrues interest and allows them to do expenses easier? So once you start thinking in that way, even if your business is a SaaS business, or even if your business is a marketplace or anything else, once you have those primitives, I think it allows for a lot of creative and valuable products to be built.
Yeah, Adam, I would add there that increasingly, I think it's become the case that you kind of have to earn the right to monetize payments. And so, like, what that means is you can't just launch, like you said, like a pure play fintech that just says, hey, I will help you solve your payments problem. It's like, feel solved in some ways. Like, what are you really providing me? And it's like, if you can provide like workflow automation software, like ideally even verticalized, that solves my exact pain point, and then your monetization strategy just so happens to be that you make money off of the payments that's flowing through the platform, fantastic, right? Like, that's a win-win proposition. You can make money off of that, but also you end up creating more sticky customer because you're providing that much more value to me. I think so increasingly, that's probably the direction we're shifting. Now, what does that actually mean for, like you said, the true pure play fintechs that want to get up and running? I think you really want to be solving a very difficult, sophisticated problem at that point to compete. Because again, like, you really need to earn the right to monetize those payments. And so, like, you can't just be launching a vanilla payments or banking product. You want to do something difficult that the vertical SaaS folks that are embedding financial services can't just do tomorrow. So, like, you want to play in trade finance, freight forwarding, cross-border banking and payments. There's a company, Avon, that does like HELOCs and like allows you to basically spend on a credit card, and behind the scenes is like an asset-backed loan based off of the value of your house, right? Like, that allows you to reach a more subprime audience that you couldn't, not just any financial institution could lend to. So, like, you need to really do something different and challenging in that way, because otherwise it's going to be unlikely that you'll have a real moat or differentiator.
There's something that, and it's kind of coming up here a bunch of times, but earning the right to monetize through payments, these different ways of kind of getting customers. And I got to talk actually to Howard Lindzon, who was early with the Robinhood guys, and he's a talks a lot about fintech investment and all that, and whatever. Now back in the CEO chair at StockTwits, where he said that the magic moment with Robinhood was not, of course, the zero fee or whatever, but actually the customer acquisition cost being so low that they had like this marketing moment of that they were onboarding users into this, ultimately something that monetizes through, this type of stuff we're talking about at like way, way below what typical people, what someone pays for it normally, what someone would normally pay to onboard, like what TD Ameritrade would pay to onboard a new trading client. Let's say it's $500 or something. I like those numbers are actually, customer acquisition costs in fintech are absurd. And Robinhood's doing it for $0. And that was like, for him, when he was having the conversation with them, obviously there's the tech that earned them the right to have that low customer acquisition cost. But in my brain, it's that customer acquisition number that always ends up being like the aha, like the actual like scoreboard of earning it. Like, if you have to pay a ton, right, from marketing to get someone on your seventh, the seventh dog walker bank, you're clearly not earning it. Like, you're marketing, you're paying a lot for marketing, the product's not earning it. If you're, charging less fees than anyone in some sort of magical, Citadel pays you on the back end equation, then you earned, this really low customer acquisition cost. Is in terms of how you both think of it, and maybe the infrastructure layer is different than Matt, but in terms of when you're investing and thinking about it from the investor chair, do you think about customer acquisition costs in that, like, earning it? Is there like a healthy amount? Is that in the topic of conversation, or is that just more purely if you're, I don't know, maybe it's more specific, and like more specifically if you're like a consumer app, obviously customer acquisition cost is like a huge, key metric or whatever. But if you're on the B2B side, maybe it isn't. Is that, I don't know, a way to think about it?
Yeah, I think in both, it's equally important, and not just important. At least for me as an investor, having a very good answer and ideally great data to back it up around what your CAC is and why it's competitive is one of the top three, if not the most important thing. Because to your point, like, a lot of this, the infrastructure is getting better. It's easier to build payments acceptance. It's easier to build issuing than ever. It's easier to build, almost even software as well. You have all these low and no code tools, and I'm not an expert in AI, but there are all these things on how you can build these, build a lot of stuff faster and cheaper than you could in the past, and plug in all these financial services. And so building the thing is no longer hard. Finding something that a portion of people will pay you for, and being able to get them at scale is the critical thing. And CAC is often a good indicator of that. And that's why this isn't a blanket rule, but CAC is easiest answered when you're talking about paid CAC. Like, I can spend this much on Facebook and get this many users. But often the best companies have, I don't want to say a viral sort of thing, but take Afterpay as an example. The beauty of that company and that model, and just buy now, pay later in general, is you did the consumer acquisition through point of sale. So I go to buy a t-shirt on, whatever, some e-commerce store, and the merchant is advertising Afterpay on their checkout page. They're on the product page. They're saying, hey, don't pay $100, pay 4 times $25. Like, and that was effectively free consumer acquisition. We didn't have to go, spend a bunch of money. Eventually they did direct consumer acquisition, but those kinds of, that's just one example, but those kinds of, hacks, if you will, make a huge difference in any business, but particularly in financial services, fintech.
Yeah. Nikil, different for you guys, I guess.
Kind of, yeah. But sorry, just to add to Matt's point, because this is really interesting, actually, to chat about distribution. The one additional complexity that you also want to think about when you're in financial services is when it comes to distribution and customer acquisition, you want to be really careful about like an adverse selection problem, right? So like, let's say you're lending. The easiest thing to do is to hand out money, right? You're going to grow. There's going to be people signing up. But now you need to make sure that you're getting the right kinds of people who have the capacity to pay you back. And so like, it's not just the growth number and distribution. You also want to make sure you're reaching the right folks who you're going to be able to profitably lend to in a safe way. And so that's like an additional dimension there that if you haven't been building in this space can be quite challenging and can put you upside down. Like, you could show 1,000% month-over-month growth, but if you're not getting paid back, or if you just onboarded a bunch of fraudsters, you didn't solve a problem.
Yeah. Well, I want to, there's a couple of other things on the sheet I wanted to get to, and I know we're coming up here on the last kind of 8 minutes or so. I think that, I'll bundle the two things kind of into the same thing. When you look around the fintech space, and that can be, fintech more generally, or payments more specifically, where are you seeing like innovation? Like, is there anything that, like, what's jumping out to you? And there was in the pre-show thing, there was the pay by bank kind of moment that was happening. And Nikil and I actually talked about where I never really got it from the consumer side. But there are kind of themes, I think, that are popping up, and new themes that may or may not be the future, right? Or may or may not survive. What comes to mind there? Like, things that you're seeing, the early kind of innings that you feel you're seeing the early innings of, and may make it, may not, may continue to develop, may not, across the fintech space.
So me personally, yeah, I'm happy you brought this up. Me personally, like I know there's been a lot of buzz about pay by bank and ACH and merchants love pay by bank. Like I never quite understood that, because to me fundamentally, like there's no consumer value prop there. It's a merchant value prop to say it's a lower cost of acceptance. Like me as a consumer, I don't actually care if the merchant's paying 5% or 2% or 1%. Like I want my reward points, and if I can use a card at a merchant, I'm doing that every time. I know how it works. There's no friction whatsoever. It takes a second. And like, voila, I paid for my trip to Italy if I do that frequently enough. Like, that's fantastic. I think, though, that there are use cases for it. Sorry, I should say similar thing for like RTP, real-time payments, which is coming out soon and like gaining a bunch of traction in the US. Similar thing is saying, is that a threat to card networks? I really don't think so. For that primary use case of like consumers paying businesses, I don't think it's really a threat. I think, though, it can be big for like disbursements and payouts potentially. Like when you think about payroll, for example, like, it could be attractive if a provider says, hey, the second you finish your shift, money's going to land in your account. You don't have to wait and get paid every 2 weeks. Amazing. I love that. I'd sign up for that thing. Right. So I think that you really have to figure out what use cases some of these new innovations will be useful for. But yeah, the pay by bank thing, when people talk about how it's a threat to cards, I just don't see it.
Matt, any pay by bank portfolio companies? No.
we have no pay by bank, but similarly, it's I've seen that pop up in the wild, the option to pay by bank, and to your point, like it's the hassle as a consumer to log in and do this and do that is and sign up is like still too much, is very, very high, and the benefits I get as a consumer are so low that gap it's not surprising that there's not a massive amount of adoption there. Yeah, can always change.
Any themes though from your side? I mean, obviously this is what you think about when you're putting, writing seed checks and thinking about founders, and any themes that you can enlighten us on that you think are maybe, gaining steam or new and could gain steam?
Yeah. I would say one that's I'll mention one quickly. It's a little more mature, but still has a lot of ways to go. And one that's earlier. So the one that's more mature is embedded fintech, like the ability to, again, put financial products closer to where the users of those products actually are, which is in typically some kind of software product. So again, not having to go to a separate company or bank to sign up to accept payments in a small business, but have that offered inside of Toast, or have that offered inside of whatever software I use to manage my landscaping business. And it's not just payments, but it's all the other financial services that I need to run a small business. For example, I had on my Substack, I published like this research on looking at all these vertical software companies and how many of them offer different types of embedded financial products. So saying of these like 200 or 300 vertical software companies, how many of them offered embedded payments, how many of them offered embedded banking, how many of them offered embedded spend management. And I think payments acceptance was the highest at like 80%. But then past that, I think the next highest one was like 20%. So of the small businesses that used this whatever vertical SaaS company to manage their small business, no more than 4 out of 5 of them offered these financial services that these small businesses were getting elsewhere. And so that it doesn't mean that there's not opportunity for that. It means that it's just not being offered in a way that these businesses are used to getting it today. So a lot of room to run there. I think the second one that's a little more kind of emerging, we talked about how payments acceptance and issuing, all that infrastructure is commoditized and easier to use. I think one area where it's not still are in these categories of restricted spend. So, one example are government spending around EBT and SNAP benefits. We do have a portfolio company here called Benny. I think Benny API is their website, and they make it easy for merchants to accept EBT cards, which are kind of government funded programs. There are other categories in healthcare and different categories of restricted spend. HSA and FSA is another one where these funds, these oftentimes billions or trillions of dollars of funds, are sitting somewhere, but they have to pass through very particular pipes in order to reach the merchant that your Stripe today or whoever it is typically doesn't accept. 529 payments for tuition is another one. That's a category of this like set aside regulatory bucket of funds that measures in the hundreds of billions of dollars, I think, in the U.S. And the government is allowing 529 funds to be used in a greater number of things, but they have to pass through these very narrow set of pipes in order to be used. So I think unlocking those for online or more digital transactions, these broader restricted categories are pretty interesting.
Yeah, very cool. Nikil, you want to give us we talked about how you don't like bank to bank. What do you like? What do you like besides Lithic?
I love fintechs that have a bunch of hair on them in terms of the idea they're executing. Like, that is what makes it differentiated. That is what makes it challenging to build, and that's why it's valuable. Like, and so I still see some ideas, like kind of to Matt's point, that are building in like really regulated spaces. Like maybe it's something to do with like FSA, HSA cards, which can be complex when you think about eligibility. I love stuff that has to like do with the intersection of healthcare and fintech. So like, claims eligibility, reimbursements, stuff like that. I think there's just a ton of opportunity. We're seeing a lot of companies right now using Lithic's infrastructure actually in terms of card issuing to go out and innovate in like the fleet and trucking and fuel space, which is again massive industry. Lots of incumbents there that just are building still very much like batch and file processes, and so like some of these new startups are completely turning that upside down and innovating. So we like stuff like that. I think anything that is really taking on hard to execute problems, I think that's what's exciting.
Yeah, not a rapper,
right?
Maybe a hard rapper, a hard to wrap, hard to wrap problem. No, really great guys, and I really appreciate you coming on to kind of educate us all on this stuff. It's super interesting, and I think that it's something that everyone, a lot of the audience at Sandhill and the newsletter and the Twitter and where we'll send this out are kind of in the space, right? So I think experience this on the fintech side, but I also think that and I've just again been educated on by you guys, been educated on by my friend in the space. It's so vastly complicated. How easy it is to like swipe your card or to pay, right? It's so there's so much under the hood, like this massive industry. So super cool to hear about it and to learn about it from you guys. We'll be clipping this up and sending it out. So thanks for joining us, and hopefully we'll all talk again soon.
Thanks for organizing.
Yeah, absolutely. Talk soon.
Cheers. Yeah.